Goldman Sachs closely monitors a measure called breadth, which assesses the degree to which the market's returns are being driven by a handful of stocks. The firm's breadth signal is flashing yellow, and Goldman says investors should be wary of a meltdown. There is, however, a surprising market dynamic playing out that could help insulate stocks from a surefire sell-off. So let's take a look. As the stock market enjoys one of the best earnings seasons in recent memory, an ominous situation is threatening to bubble up under the surface. It has to do with the market's heavy reliance on just a small handful of stocks, bringing a closely watched measure known as breadth into potentially perilous territory. Goldman Sachs finds that the top 10 contributors have accounted for 62% of the 7% year-to-date return in the S&P 500, which has breadth hovering near its lowest level on record. And of those 10 companies, 9 are in the tech sector. This is reflected in this chart here, which shows that a breadth index maintained by Goldman that provides readings between 0 and 100 is sitting at, you guessed it, 0. And this is another chart showing falling breadth from Morgan Stanley. So what's the big deal? From a fundamental perspective, narrow market leadership typically reflects narrow earnings strength, which is often a symptom of a weakening economy. What's more, the decline of breadth to such low levels has historically preceded meltdowns on both the market and economic fronts. The period immediately before the tech bubble was marked by extremely tight breadth, while similar conditions in 1990 and 2008 preceded economic recessions. Breadth was also notably low during the non-recessionary economic slowdown seen in 2011 and 2016. And usually, these narrow bull markets eventually led to large drawdowns when investors lost confidence in the increasingly expensive handful of crowded market leaders. This chart here from Morgan Stanley shows the increasing importance or concentration of technology in the overall return of the S&P 500. But Goldman still thinks that the market can come out okay, at least in the near term. And that's because the conditions surrounding this particular instance aren't as troublesome as they were during past periods of turmoil. It all boils down to today's earnings landscape, which Goldman identifies as a saving grace of sorts for the market. While market returns are highly concentrated into a handful of stocks, Goldman finds that the earnings environment is surprisingly broad-based. The top 10 S&P 500 stocks account for just 20% of index earnings, which is right around the average for the past several years and just below the 30-year average of 21%. Going forward, it'll be up to investors to continue assessing the relationship between market breadth and its earnings-specific counterpart. If corporate profits stay widely distributed by comparison, it should alleviate some worries that a major stock sell-off is imminent. It's when earnings breadth starts dipping that investors should start to worry. So keep your eyes peeled. And for today, that's ChewDog Charts. Thank you.